Hello and welcome to the Harwood Report for October 1st, 2017. As always, the Harwood Report is presented by Trade Academy, and I am your host, Keith Harwood, the founder of Trade Academy. We always start with the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Do your own due diligence before entering into any trade. I will talk through some of the ideas that I am looking at, but that does not mean that you should go out and do anything before you review the trades for yourself and determine your own risk profile. Consult your financial professional if you have any questions. This week's highlights. So we're going to go through our normal stuff: equity indices, S&Ps, NASDAQ, small caps, Dow Jones, go through the rates of Forex and commodities. Dollar yen, still an interesting trade. The impacts on gold and the miners are particularly interesting right now. I've been focused on oil. I want to look at oil again. We'll really focus on the USO since that's been really where we've been focusing on our trade trigger. That'll drive us into XLE, the normal energy index, and I'm actually going to talk more about AMJ. The MLPs are getting a little bit interesting here, and I think there might be an interesting setup there. Finally, we're going to go through semiconductors. SMH is getting some flow here. You guys may have noticed Micron, NVIDIA, and some of the smaller cap names as well getting interesting. And then finally XLP, consumer staples. Interesting trade there, actually. It's not one I've normally looked at, but after reviewing that a little more closely, I think there's some potential there that's getting a little bit exciting. So without any further ado, why don't we jump into some of the stuff here. First off, we've got fear and greed at 85. This is an extreme high level. It's extreme greed, but right now it's actually maybe justified. There has been a nice move here. We talked about it 80 as being a pretty high level for it to break through. Sometimes you get a little bit of a chop through up to maybe 90. But if tax reform is really going to happen, that's going to put some money flow into the markets, get some people confidence, and we may be able to reach one of those high extreme greed levels. At a minimum, this probably puts me a little bit more into a sideways trade. But, when we looked in, say February, we had a nice move there. Late 2016, this was the election, had it got to extreme lows, go straight to extreme highs. Here we had the first North Korea stuff go from extreme lows to extreme highs. So I think there's some reason for optimism in all thanks to tax reform, but I think we got to be thinking sector rotation just because we've gotten so far, so high up here. So something just to think of as a flag here for the overall market. Doesn't mean it's bearish. It just might mean that you get a pullback or some sector rotation instead of that breakout to the upside. Let's go back a little bit to last week. Monday we had a dip down in the S&Ps to the 20-day moving average. Looked like maybe things could roll over with the threat of North Korea saying that they thought that we had declared war, but obviously nobody believes in the United States has declared war, so that didn't really mean much. We bounced back. Started talking tax reform. That got us into new highs here. Then we had the breakout on Friday into the end of the quarter. So we had a lot of end of week bullishness driven by tax reform and the expectations of what can come from that, and of course end of quarter window dressing. And that's what really makes me think that some of this stuff may get a little bit more money flow into the beginning of the next quarter as a result, but people are trying to make sure that their books look good at the end of the quarter. Some of the bigger names get a little bit of extra money, but that doesn't mean that these names have to stop going up that are going up. It just might mean to me that some of the names that have slowed their descent may pick back up some bearish flow here. People just generally don't want to show a lot of bearish positions on their books at the end of the quarter, and they may have cleaned up a little bit before looking for new shorts in the market. So for the S&P, in general, there are two things I am watching for here. If you're going to get a rollover, we're going to have to get obviously below the 10-day moving average. That gets you at least a little bit of something to trade against as a stop if you're going to be short. Look at the MACD here. Generally, you get these rollovers that just haven't produced massive breaks, but at least then that you're going to be doing some consolidation. Here, we had what looked like a potential rollover at the end of the week, crossing back bullish again. This could trigger a little bit more movement. Last time I remember seeing one of these kind of moves, and you can go back on the chart here, you had two. You had one here, where the MACD failed really to get any momentum for the either pullback or sideways action, and that created a move from 240 really up to 244, 245, so about 2%. And here we had the move from about 229 all the way up to 239 over the course of about 2 to 3 weeks. So we've got this potential to have one of these kind of moves here where you pick up anywhere between 2 and 5%. I'm not looking for 5%, but maybe 2, 3, 4% into the beginning of October. Could be interesting. The one thing that maybe slows that down a little bit is, generally speaking, through earnings seasons, we've been a little more sideways. So you can see July, very sideways. Go back to April, very sideways, but we did get a little bit of flow at the end of April. So earnings has been a sideways chop trade. I think that basically what we're going to end up with is either sideways or bigger upside. I don't expect the major pullback down towards even the 50 or 100-day moving average here. To me, it's either a sideways or bullish flow. So that's just the general backdrop, I think, on the markets here. I'm not bearish overall. There will be sectors that will be bearish, and we'll talk about them later. I think that, if anything, if you're looking for a potential big move, it's more likely to be the upside unless something gets really nasty with North Korea. Qs have been a lagger. You can see that they are not at all-time highs. S&P's at all-time highs. Small caps are at all-time highs. Dow Jones is pressing against all-time highs. Qs had a little bit of lag here at the end of, not this past week, but the week before. It kept there with the North Korean threat. Started catching up on Friday. FANG names just haven't been that strong. I think there's been a bit of rotation out of FANG and into some other names, particularly in small caps, particularly with tax reform, and that's where you see it here in IWM. It's been an incredible run in the small caps here. And tax reform day, the 27th there, massive move. We've got a little overextended to me in IWM. I think that we're probably going to go sideways until the moving averages catch up a little bit. Again, that's not a bearish call. It's just you've got to see maybe 4 or 5 days of catch up here, create something like maybe a bull flag where then we can break out for new all-time highs as we get some consolidation and digestion up in this area. Haven't spent enough time up here on its own to really be the next leg higher for me. So again, I'm not really looking for anything specific to small caps as a trade. Dow Jones actually might be a little more interesting to me on the industrial average. We've been riding the 10-day moving average, and we've got this little bit of a box. You can see that we've really been trading between 220, just under 224 and 222. So this kind of $2 range over the last 2 to 3 weeks. Break out to the upside, that could get us some nice movement up towards 226. Break out to the downside, that gets us back towards 220 and the 50-day moving average. It's not a huge move, but it's something to trade around if you're looking for it. We've held the 50-day moving average really well in the Dow Jones over the last 6 months. So if we get that breakdown on the box, you could maybe play for a move from 220 to 222 to 220, but I'd be more inclined to buy against the 50-day moving average on that break than play for the small amount of money you make on that break. If you want to play for a bigger move down, you go short below the 50-day moving average rather than short below the box. Go long above the upper limits here, really above 223.95. So call it 224 and above. You maybe look for some calls for the next breakout there in the Dow Jones Industrial Average. So there's your play. The one trade I talked a little bit about SPY at the very beginning. The one trade I'm going to look at a little bit here, just because vol's so low. You look at October 6th. Calls are trading 6.5%. That's this Friday. You go to next Friday. The upside's trading 6%. Go a little beyond that to say the 20th. And you've got some calls, trading 6.2%. You've got an interesting potential here if you go all the way out to the 27th. So, oops, I went a little too far. There you go. The implied vol is not updating for me. There we go. Let's go down here again to the 27th and look. If we get that kind of breakout move, you can get into the 255s here for 43 cents. And, if that gives you 3 weeks for that move potential to, if we get that 260 kind of move. If you want to go a little shorter dated, I'll look at the October 13th, maybe on Monday as well, because you had this bigger order here buying about 10,000 of the October 255s for 13 cents on Friday. You maybe go a little bit closer to the money, the 254s for a quarter, get a little bit higher probability of these playing out. You could see this kind of move if we just continue higher. I don't think it's going to happen again in the small caps. I think it's going to have to be led by S&Ps, Dow Jones, or the NASDAQ. And that, given that buyer here, I might be intrigued by playing with this vol at 6%. It's just so cheap. That's my breakout potential move. I don't think it's necessarily a high probability, but if we continue higher and we get that move like we had 6 months ago or in February, it gets interesting for me to get the R&R up there. If this has got a 10 or 15% chance of paying off, but it gets you 10 or 15 to 1 R&R, it's worth mentioning. Let's go to the Forex, because this is where we have a little bit more clarity, I think, on the structural type trades. This has been a beast, the dollar relative to the yen, risk on. All risk on all the time. The MACD's playing a little catch up here. Maybe you get a rollover there, but without that rollover, we're holding above the 10-day moving average. Just no let up there. Tested it with the North Korean threat on Monday, retested on Tuesday, and then just drove ourselves right back above the 200-day moving average and back into this bullish trend. So, I think the dollar yen's going to just continue firmer here for at least another week. And then we look for the cross back below the 10-day moving average. You see where it happened last time in the middle of July. 3 months ago. 3 months ago we were here. You get a little bit, maybe another week or two of bullish action. Then it starts to roll over, and then you can go look at the bull side of gold. But right now you've got to be bearish gold for at least another week or two until we see that move below the 10-day moving average and the flip in the trend. What does that mean for GLD? It means GLD is going to probably, if I'm right here, GLD's got to finish this move down to the 100-day moving average, and more likely it's going to the 200-day moving average. It's a decent sized move, $3 over the course of 2 weeks. You can play it with the options. We pull up GLD options over here and just take a look at the vol. It's not too expensive. It's not too cheap either. It's near, 2-month lows. But it's really in the middle of the range for the last 6 months. If I had vol down here towards 9%, I'd be more excited. Vol tends to pick up on a rally, so I'd be more inclined to be a buyer of gold GLD options if vol was, if vol was here and I was bullish. But since I'm bearish, I'm not really excited about buying options. You go 3 weeks out. If you're playing for that move to 118, you're really looking at kind of these 119.5 puts. It's decent, 3 to 1-ish R&R. You pay 45 cents. Maybe they can get to $1.50. It's not that sexy. GDX, on the other hand, I think there's a little more there. So we're at the 200-day moving average here. We're getting ready to trigger some stops. Momentum maybe picks up as soon as we get below the last 2 moving averages here. We are on top of both the 100 and the 200-day moving average. You get a little more leverage out of the miners. This break could create that kind of flow that pushes us right back down here to 21. Nice little 10% break there, $2. And I think it could be a washout type move. Last times we've seen us get below all the moving averages. You had a washout move pretty quickly there over the course of about a week, week and a half. Washout move there over the course of a week, week and a half. The key is all these other moving averages are above the 200. And when we cross here, because if you get below the 200, sorry, this is the 100-day moving average. Once you get below the 100-day moving average, you get that crush. All these other moving averages got above, got a lot of people bowled up, and now if we can get back below, it get a little nasty here. We look at GDX. Vol. Hey, that's a lot more exciting than GLD, right? We're at 6-month lows in vol, with price looking ready to roll over. Dollar yen continues firm. This is going to roll over, and we can get some pretty good velocity to that move. October 13th is cheap. But remember, we're looking at vol on the norm being closer to 26%. So I don't mind adding a little bit of time here. Going over to the October 20th puts. I was talking about that move down towards 21. Look at these. October 22 puts. 17 cents if you pay the offer. And those go to $1 on a move to 21. That's pretty nice. 21.5 puts are about half that price. They'd get the same kind of percentage return, so you don't necessarily need to go all the way down there. But man, I like these October 22 puts with the potential there for retesting the previous low, get a little momentum. Those could pick up pretty well. So that's where I'm going to be looking tomorrow morning. Hopefully we don't get a rollover in gold overnight. Last time we were bearish on gold, we got that rollover 2 weeks ago overnight, so we didn't really want to chase it. If we start getting the rollover this time, I actually am more inclined to chase it just because I'm looking at these already as having a 5 or 6 to 1 R&R. You can probably still get in them in the morning at a 4 or 5 to 1 R&R, even if we start the rollover process overnight tonight. So there's a lot of upside to being long these puts, and I really, really like gold miners on the short side as a result. So that's my big play here off of the dollar yen. It's gold miners. Let's go over to the oil side. So staying with the commodities, talk about oil. What a week. So Monday, North Korea threats maybe put a little bit of a bid to oil. Close above the 200-day moving average finally. Gets a little bit exciting here. Creates a nice bullish undertone to all of the oil sector ETFs, all of the oil names, all the domestic producers, all the domestic everything. Stayed above the 200-day, stayed above the 200-day. Tried to break out. Looked like maybe it was a failed breakout and we were going to go back below the 200-day moving average, but we are holding it. The 10-day moving average is now catching up. This kind of reminds me of what we just saw in dollar yen, where we tested the 200, above and below the 200-day moving average until some of the shorter term moving averages had a chance to catch up. If the 10 crosses the 200, that gives you a little bit more short-term support. As long as we hold above the 200-day moving average, basically I'm looking for bullish plays in energy sectors. So why don't we go first to XLE as a what if it doesn't hold? Because XLE tested above the 200-day moving average, but looks a lot like it's going to be rejecting here. MACD hasn't crossed yet, so we're not quite sure. But if this can't hold, get above the 200-day moving average and hold, it's likely going to be driven by a little bit of selling in crude. And in that case, this is where I want to trade my short from the short side, because this has a very clean stop here. 200-day moving average not getting through and then pulling down. Should get quickly below the 10-day, quickly below the 20-day, and start pressing down here towards the 50-day moving average over the next, say, 2, maybe 3 weeks. Sorry, that's the 100-day moving average all the way down there. This would be, no, I'm wrong. Yeah, the 50-day moving average is actually a little bit lower down here at 65. The 100-day moving average is 65.5. So XLE's got some interest to me on the short side if crude fails above the 200-day moving average. Crude, again, USO has to get back below the 200-day moving average and give me a signal that maybe this bullish run has run its course for now. XLE volatility is extraordinarily cheap. Normally trades around 16%, currently trading closer to 12%. It is ridiculous. A lot of this is driven by producer hedging. So producers come in, they hedge by selling calls in crude. Traders are then looking for correlated products to crude because now they're long a lot of upside volatility in crude. They sell calls in all of the producers, thus the volatility depression of XLE. Go to the options, and that gives you an opportunity to maybe get some really cheap stuff. You go to October 20th, 67.5 puts. These are only 40 cents. There's a little bit of a skew here up to about just under 13%, but 40 cents on these gives you a great R&R if we get that pullback down towards those key moving averages, 65.5 range, 64.5 range. I mean, this is a big potential move for something that's got 40 cents and it's only a buck out of the money. I like this as your play. It's a little bit of a balance of return, off of having some gamma here, a little bit of vega, and it has a little bit more probability than going all the way down to, say, the 66s playing for the big break. If you get into these, you can roll them down as you break, if we break. But again, I need confirmation that we're going to reject the 200-day moving average, and again, I need confirmation that USO starts to break. Without that, I am not making this trade. Without that, I'm going to go to the lagging sector and look at the MLPs. So MLPs have really been the weakest performer for the energy sector. People just, for whatever reason, don't want to flow their money in there. But if, as a subsector itself, it could play some serious catch-up if oil really does continue firm. If oil continues firm, this is the one that's got the most catch-up to play. And because it's got the most catch-up to play, that means to me that you can benefit from the cheapness of calls and that benefit of cheap call skew. You get some potential explosive upside if this becomes a catch-up play instead of a lagger, and you've got some great upside. I'm a little nervous about how we've normally handled it in the past. You know, we've bounced up to the 50-day moving average before and failed. We got above here briefly and failed. We're not above the 50-day moving average right now. We need to get above that quickly. And then I think that there's obviously you get above the 50-day and we're going to start looking at the 100-day moving average, but I don't think that's going to provide a lot of resistance if we can get it clear of this 50-day moving average, just because we've got so much catch up to play. I mean, you look at where we were back in the beginning of August, it was $30. There wasn't a lot of trade here between 28.5 and the 50-day moving average, 100-day moving average of $29. This was kind of a gap down mode here at the beginning of August. So I'm thinking to myself, if we get above here, we start talking about getting back into this consolidation area closer to $30. And let's just look at the vol here. It's very similar to XLE. On lows. Realize vol's been kind of low because it's been lagging and just been a little bit more sideways. You know, vol should go up towards 17.5% into that rally even. And I go out to the October 27th. It gives me a lot of time for this to play out. And you can see it's a little bit cheaper than the October 20th. Look at these October 27th, $29 calls, and even at 20 cents, if I have to pay a little bit above mid-market, this has got some serious upside to me. You know, I was talking about a move towards 30. It gives you a 4 or 5 to 1 R&R just off the cheap vol. You may be able to even get these cheaper. These may trade for 15. If, I wouldn't be surprised if they don't. But I'm looking at these for around 20 cents and just thinking about the potential for the upside there if this sector plays catch up. Two more for you. We're going to go over to SMH and take a look there. We've got, I mentioned the semis just getting a nice bid. Micron had earnings very bullish. NVIDIA got an upgrade on Friday, very bullish. We've got a lot of the big names getting a lot of flow, and we're starting to get some of the small names getting talked about again. The small names really helped this guy drive higher before. Look, MACD looks a lot like S&Ps. You had the attempted break there and it failed, and now you're bouncing. This is one of the strongest subsectors of the NASDAQ, which may have some catch-up to play. This could be the one that helps drive NASDAQ into catch-up mode. I just think that this is a very attractive-looking chart after holding at the 20-day moving average and then turning up. So we go over again to our options here and realize that, as always, vol's cheap. It's not as low as some of these other sectors like what we saw in oil, but it's on the low end of the average. Realize volatility is starting to pick up here. Buying vol at 17.5% is pretty nice. And if you go out to November and look for some upside calls, you can buy in 17%. So I like these Nova 96s for $122.5. We continue this breakout mode, and this should be a sector that gets some money into it after it kind of lost its luster and people lost their love for the sector. So I like SMH as an upside play here. Looking at the 96s, maybe the 97s. I wouldn't really go any higher than that, but I think this is kind of your range here. So I'm looking at November 96s for $122.5 as my play for SMH. And finally, XLP. We've got Staples Select Sector, our spider. So this is a sector that just can't get a bounce, and it is just a disaster mode here. Even though the market has been rallying on the whole, this sector isn't bouncing off of lows here. It's not near 52-week lows. Obviously, you go back here, and it's been significantly lower down towards 50. But the low here in July was 53.86. We've held that so far, but it is in our sights. We're below all the key moving averages. We've failed at bounces towards the 10-day moving average. It just looks nasty here. And if we're going to do a sector rotation game, I think the weakest sector, the one that's not getting any money flow in, is going to start getting money flow back out. You're not participating in the upside. If everything else starts to rally, this is what it's not rallying. Why would you stay in it? So we go over to XLP and look at the options. Oops, I didn't put that in there. And we see here that on the chart, volatility is a little bit higher, but it's only 8.5%. You get cheap options here. So we're going to look over down towards October 27th. And we're looking for me at the 53 puts for 19 cents. I mean, if you can get those for 19 cents, I get it. The volatility sounds expensive, but there's no reason for this market to be supported below about 53.5. There's just a vacuum of buying here to me. It means you should get to 52.5, maybe even all the way down to 52 before you really find some, a place that we've had some trade in the past, a lot of trade. And this is, a year ago. There's not a lot of reason to support this market, this ETF, until you get down into this range. So that's why I like these 53 puts for 19 cents, excuse me. Over the course of, 4 weeks almost. 4 weeks, I guess. You get 4 weeks for 19 cents for a move down here. It's got a really attractive R&R. So that's how we wrap it up here, folks. I tried to run through it as quickly as possible, but basically, I'm thinking that you're either going to go sideways or maybe the explosion higher because of tax reform bullishness. S&Ps, NASDAQ, Dow Jones, I actually think are the easier long to play. I know that IWM is the one that's had all the momentum, but I think that you're going to get some sector rotation as people try to play the catch-up game rather than trying to really focus on those. Maybe you're wrong. If tax reform looks really clean, people are going to go small caps again. Fear and greed is our flag. We're a little bit nervous about that, but I think you go more than likely sideways chop in IWM. More than likely, it's probably going to be sideways in general, but if you want to play for an outlier upside play, look at those SPY calls. They're very cheap at 6% vol. Dollar yen still looks bullish to me. I think we're going to continue to see people rotate into the dollar and play that quote-unquote risk-on game. That means you got to get rid of gold. You got to get rid of gold miners. Miners have the low vol. They've got the most explosive downside. That's where my play was, looking at those. October 17, 22.5 puts around 20 cents. Oil looks good above the 200-day moving average. If that fails, I'm going to look at XLE as my bearish play. If it holds, bullish plays in AMJ, the MLPs there. Semi is getting sexy again, so we're looking at the calls there. Consumer staples still look weak, so that's your weak sector to me, and that's where I'm looking at the puts. So a little bit exciting here, guys. I'm going to start working on some more in-depth analysis here on the Harwood Report, and we're going to get a newsletter and some premium videos to go along with this free video. I'm going to continue to do the free video every week for everybody, but if you sign up for the premium product, you're going to get a newsletter that outlines more ETF technical analysis, more options analysis that pair together for these explosive return profiles. I'm going to talk about a number of ETFs that I didn't touch on here in this free video. I'm going to talk about some option structures that are a little more complicated than these outright long calls and puts, ways to trade some of the nuance of options in order to get a little bit better R&R. I'm also going to have some extended videos, subscriber-only trade ideas that will come through the newsletter, as well as through some videos throughout the week. So there's going to be a lot more content that's going to be coming out for the premium product, and I will continue to follow through on instruction on how to pick the best option structures for these setups. So you get a little bit more of a learning how to find these for yourself. I think that's important. Being given trade ideas is nice because you can figure out the backdrop behind what who've been doing this for years are thinking, but it means nothing unless you start figuring them out for yourself. And so I will try to walk through some of the reasons behind these trades as opposed to just here's a trade, don't ask why. So because I'm just launching this right now, we're going to make the first month for free. Free offer is only going to be extended to the first 100 subscribers, so you're going to want to act soon. And after that, the regular price will be $49 per month. So, the amount of content that I'm doing here is worth well over the $49 per month. The benefit to you guys is you get it cheap. The benefit to me is I expect then that I can get a lot more subscribers, a lot more interest, and justify my efforts here. So I hope you guys have found everything that I've been doing for free so far to be interesting. If you find it interesting and you want more, sign up now. I'm going to put the first premium newsletter out later tonight. So keep an eye out for that if you sign up now. Go to tradeacademy.co/learn to sign up. Otherwise, contact me the normal ways. Go to the website, tradeacademy.co, email me, keith@tradeacademy.co, call me 312-600-8004, and hit me up on Twitter @tradeacademyco for watch lists and market commentary throughout the weeks. Thanks again, everybody, and I hope you have a great week in the markets.